This is Lance Bryce with Thrive Mortgage. Today is the 29th of September, Thursday. Hope you're doing well. Interest rates continue their march higher. In fact, we hit a very unfortunate milestone this last week. On Tuesday, Mortgage News Daily showed in their daily tracking of the 30-year fixed rate conforming loan that we ticked over 7%, up to 7.08% for the first time since April of 2002. So a lot of folks have not been in the business and seen 7% rates at any point during their careers. That's probably the majority of y'all. I'm old and crusty, so I've been doing this a while. I've seen rates much higher than sevens, and we were still selling plenty of real estate and still closing plenty of loans. So y'all, just a reminder as we go through this increasing rate environment, jobs is what drives home sales in a normal environment. Now, we have had a very highly subsidized market over the last couple of years with interest rates that were way below established norms over the last several years, and that drove a tremendous amount of activity. Obviously, we're going to see the majority of that activity slow, but let's talk about the fundamentals of a strong market. Unemployment or a strong employment is what drives a normal market's transaction of houses. And we still have very strong jobs numbers, y'all. We do not have a cataclysmic event occurring here until jobs start suffering. So as long as employment stays strong, people should not be freaking out over the bottom falling out or the sky falling or any of that. I'm hearing a lot of that. We are entering what is going to be a very slowing period. The Q2 was down 0.6%. As far as GDP is concerned, those are the revised numbers. So we do have confirmed 2 declining quarters as far as economic growth is concerned. That has always meant that we are in a recession. I think our Q3 numbers will even further solidify that fact. But y'all, interest rates typically do well in a recessionary environment. So as it becomes more clear that we are seeing slowing, you're going to see a lot of money come out of equities and move into the bond market. That increased demand for fixed income securities will bolster prices and it will push yields lower as we get into a recessionary environment. So all is not all negative when it comes to the future. Again, if you'd like to visit with me further about this or have me price scenarios for your buyers, we pride ourselves on giving your buyers the best possible information on when to lock, on the cost of waiting. We do all of that to help get transactions across the line. If you would like to visit with me directly, call me at 210-260-9660. Stay blessed, stay safe. We will talk to you next week.